Well, hello everyone. Welcome to Trading Price Patterns. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted that so many of you are joining us here live today. I want to welcome those of you who are with us both live and in the archives. But for those that are here live and participating in the chat, it really helps bring the energy to this class. And I want to thank you for that. So hello to Paul and loves to invest, and Backroad Bob. Like, some of the handles are great, right? Life in the Fast Lane, and Jay and Don and John the Noble Savage. Like, I want to meet you guys. Like, so if you're going to be in Atlanta this weekend, we're doing a live event, and you have a nickname that's memorable, in the chat, please, write that on your badge for me, so that I know who you are, who I'm communicating with. So anyway, glad you were all here. What are we going to talk about today? Well, I've got 4 stocks that we want to look at for examples. I have 2 or 3 different trading strategies that we're going to look at today. And then we have 3 prior positions with a whole bunch of trades on them, probably 5 or 6 trades. We aren't going to go into detail on all of them, but we are going to review some of our previous positions, because trade management is a critical part of becoming a successful trader. And so we want to, talk about that as well. We've got James Boyd with us in the chat. What a treat. If you are not a Boydista, in that if you don't go to James's classes yet, I encourage you to check them out. He teaches every single day of the week, and it's great to have him on board. In addition, he is a prodigious poster on X. So if you aren't following James and I in the land of X, you're missing out. My handle at Barb Armstrong CS. James is at James Boyd CS. If you were waiting for a formal invitation to take care of that, to take advantage of that free resource, consider yourself invited. Okay, so let's get through our important information so that we can get out to the platform and start talking about all these positions that I have lined up. This is an intermediate level class, or intermediate to advanced level class. We talk about trading price patterns, but I move very quickly. My assumption is that you understand some of the basics of technical analysis. If you don't, I teach a Getting Started with Technical Analysis on Tuesdays. You'll want to, even if you do understand the basics, I encourage you to check out that series on Tuesdays at, I think it's 2:00 Eastern. And if you're not familiar with all of the option strategies, today we'll be looking at long call verticals, long calls, and short put verticals. So if you're not familiar with those strategies, I will put a link in to a Getting Started series, that runs you through all of those strategies. Yeah. So there you go. Options know that they do carry a high level of risk and aren't suitable for all investors. Know that we use the Paper Money software application on the Thinkorswim desktop platform, and it's a brilliant place to learn, to become familiar with your trading strategies, and to make sure that you understand a trading strategy and have traded it enough times to be comfortable, so that you know what you're doing, both if the trade goes for or against you, before you consider trading it in your live account. We can have what I call, paper money fills. So it doesn't exactly simulate the live environment, but it gets us as close as we can. One of the other differences too is that short options will never be assigned early in paper money, and that can happen in a live account. We're going to talk again about that in reviewing one of our trades today. Okay, so what are we going to do? I'm going to have one super quick announcement. We're going to have a very quick look at what's going on in the markets and in the world in general. We're going to place some new example trades and do a little trade management. Okay, so my super quick announcement. If you have never been to a live event, it was how I was introduced to this land of investing, I must say, back in 2011. And I love attending live events as both a client and now as a coach. Scottsdale will be the first event up in March. It's a 2-day workshop. Chicago is an advanced options workshop. I'll be at the event in Chicago. And then there's one happening this weekend in Atlanta. It's Friday and Saturday. Friday's technical analysis. Saturday is options or an introduction to options. And if you're in the Atlanta area and you'd like to come, I believe registration is closed. But if you do show up, first, come and introduce yourself. And second, I'm sure we'll find you a seat and we can register you at the event. Okay, so if you've not checked these out, over the course of the year, chances are we're within driving distance or maybe a quick flight of where you are now. So, and these are free to attend. But if you know you want to go, register quickly because these do fill up fast. Okay, so having said all of that, let's go out to the platform. Okay, so the S&P 500, I'm not going to spend a lot of time on this, but it is within a stone's throw of its all-time high, which it hit on January 23rd. And in December, Santa decided not to do a rally this year, which was a little annoying. But, we had this period of consolidation in December and through the first half of January, and then it kind of broke out. And if you had a good arm, because everybody's thinking Super Bowl Sunday right now, you could probably, you're within a stone's throw of that all-time high. So hard to characterize the market currently as anything other than bullish or consolidating within a bullish trend. Now, could that change? Yes. But has it changed yet? The charts would say nay. And what about the NASDAQ? It too has been uptrending, pulled back with a little more vigor maybe than the S&P did in December and the first part of January. But we had this diagonal resistance breakout and a retest, and not quite as close to that all-time high that this one hit back in December. And then in around January 23rd, it had another stab at it. But overall, this in the last year, this index is up 20%. So the NASDAQ still maybe perhaps consolidating a little more. How about the Dow? So the Dow 30 is different from the NASDAQ and the S&P in that, you've got 30 stocks that comprise this index, and the weight of each individual stock is based on the price of the stock as opposed to the market cap of the company. But, this is close to all-time highs. Again, pulled back pretty dramatically, in December and then broke out and, has really, some might argue this is a bull flag type of pattern, which is quite bullish. And then our small caps, these guys are probably, they're in third or fourth place as far as uptrend over the last year, but, been consolidating and is flirting with breaking out, but, hasn't declared itself quite yet. So that's what's happening with our small caps. And then the volatility index, our VIX or the fear index. I think it's fascinating given all that's been going on, that it's sitting at 16. So it's down today. So kind of interesting, isn't it? And then if we look at our sectors, and I have a watch list. I don't know why my mouse doesn't want to play nicely. And if you're wondering, if you're new to all of this and wondering how I set this up, if you go to the trade management, just let me my mouse isn't playing nicely here, and it's going to be a long 45 minutes if it's not working. Okay, so when we look at which sectors have been strongest over the last 3 months, consumer discretionary, communication services, which it hit a new all-time high yesterday and then seemed to be pulling back a bit today. I don't know, is Google considered communications? Because Google did get clobbered. And it's down 7.5%. So, some of this pullback today may be because Google is a pretty heavy hitter in the communications sector, right? But, yesterday hitting an all-time high, both the stock and the sector. And then consumer discretionary has been strong, less strong in the last month. Financials have been crushing it. Technology, a little more angsty here, and pulling back a bit in the last month. There's been a lot of news that has impacted this sector, and in the last 4 weeks, materials starting, to rise up, and healthcare, financials, continuing to be strong. Now, with what's happened with tariffs, the tariff announcements that came out on the weekend, and then, the delay and everything, but it spooked the market. On Monday, we saw, a bit of a knee-jerk reaction, and whoa, don't know what just happened there. Let's see if I can bring this back. There we go. All of a sudden, all my screens went blue, which that's not an encouraging sign. Let me just see if I can bring back my chat, because I want to be able to see the chat. There we are. Yeah, so we can see on Monday things opened down and then rallied and have recovered since. And this is where I think it's so important not to make emotional decisions. And when we have a trading plan and we follow it, sometimes we get nicked out and it's really annoying. But sometimes that's the cost of doing business. And sometimes if you're thinking, when we hone in on this and thinking, I think the market is going to open lower and I think it will settle down, you might want to consider, if you have exits on your positions, just taking them off temporarily. When we have a really volatile day like Monday was. Okay, now I did not do that for our example trades, and there was one stock that we ended up out of because of this. This kind of whipping around on that particular day. So that's that. I want to look at a trade we placed Monday, and I do treat this trading price pattern class as a companion class to the Getting Started with Options series, Trading a Smaller Account series that is Mondays and Fridays at high noon. And on Monday, we saw an opportunity, because we were saying, like, hey, what sector might not be as impacted by these tariffs if there isn't a delay? And could it be stocks in the communications sector, stocks like Netflix, stocks like T-Mobile, stocks like AT&T? And so we had placed 2 long vertical trades on Netflix. And then both of those trades hit their targets. And the strikes on these, well, let's go look at them. So we placed these on Monday, and both were at 975 and 980. And we were going to compare and contrast the results. And I'll put these in a little mini session, but we ended up hitting our targets on both of these right when the market opened on Tuesdays. And we were out, we got like an 80% return on our risk in one day, and the other was more like 40%, but there will be a mini session posted on these. Okay, so if you're wondering what happened to those Netflix positions, we placed that trade on Monday, we were out on Tuesday. And so could we do another trade on Netflix, kind of a wash, rinse, repeat, and say, well, it's now sitting at 1,003. When I looked at it, a few minutes ago, it was sitting at 1,001. But if we wanted to be conservative, now, if we're really bullish on this, it did hit 1,008 yesterday. And, if you want to look at the news, I always have this live news up that I can refer to, because it just had earnings, but crushed it on earnings and gapped up, and has basically kind of consolidated a bit of a pennant pattern or a flag pattern, and then it's continuing to the upside. So if we look at coming out, let's say, to March, the March date, we'd have to do a $10 wide spread. And it's at 1,003 now. Could we buy the 1,000 and sell the 1,010? Oh, let's get rid of this one, whatever it was there. And with this long call vertical, the idea is we're buying something that we couldn't afford to buy otherwise, which is the call at $1,000. It's $41. Our max position size here, we don't want to risk more than $500 on any one trade. And if we buy a call, how much could we lose? We could lose all of it. So we're then selling a call above it to fund the purchase price. And so then it goes from $41.85 to $4.78. And so if we look at that and we say, well, you know what, that looks good to me. And our goal in this class is a 50% gain. So we're going to take that 478, like how much could we make? If you come to confirm and send, it'll do the math for you. It's saying, you know, the most we can make is 522. The most we can lose, our theoretical max loss, is 478. So we could make over 100% return in a trade, you know, that would expire at the latest by March 21st. But we could also lose the entire amount we've invested. So, you know, this kind of fits the bill in that we're not risking more than $500. But if we say, you know, would you be okay with a 50% return on something, you know, in, you know, 30 to 40 days? And so I'm going to take that 478, I'm going to multiply it by 1.5. That gives me $7.17. And okay, well, now it's going to be $3 at $5. You should have put it in faster. We'd already be up. We're going to make that $7.50. So that means we're leaving $2.50 on the table. And are we okay with that? You're totally fine. Because chances are, if we want the 100%, we have to go right to expiration. So we're going to put this in our short put vertical, or sorry, long call vertical group, and send that in. Okay. So that's our first review and our first trade, Netflix. Okay. And Netflix, when we look at the pattern here, some might call this a flag pattern, you know, where we have, you know, yesterday it closed, well, it may not have quite closed above the high of the low day if we considered this the low day, but it traded above that. And today it's certainly, you know, it's on track to close above the high of the low day if we were looking for a flag pattern and how to rule around that. Let's come and look at CrowdStrike. This is, you know, a different type of price pattern. And, you know, some might look at this and say, well, could we call this a double bottom? Well, I guess we could, you know, but could we also, you know, if you extend this line out to the left, could say, well, I see this as kind of a cup and handle. Are you with me on that? Then this is a much bigger price pattern, right? Kind of this cup and handle. Here's our cup, here's our handle. You know, coffee, anyone? Yeah. Yeah, so, you know, and now it broke out. So we had the breakout, and then it came back and retested, and it's bouncing again today. Now we do have earnings coming up. When is earnings? And, you know, so a technician might measure kind of from here to here as a target. But what if, you know, this is a $400 stock. So we could buy a few shares. We have $10,000. We couldn't buy very many, but we could buy a few if we wanted to do a longer term trade on CrowdStrike. But could we do something shorter term also? And we could. So let's look at when earnings is. So let me get rid of my drawing tool. Earnings. If there's a question mark, chances are it's like more than 3 weeks out. March 4th. So, you know, it's just shy of a month out. Okay. So can we come to our trade tab and look at, on CrowdStrike, a long call vertical, and we're at 415. So we'd want to be out before March 4th or 5th. So we'd want to come out this 23 days. Could we do the 410, 415? You know, it's at 414.25 now. It would only have to go up 75 cents and then stay above that for us to ultimately be able to recognize our max gain. It's at 263. So if we put in a target of, say, 393, that's close to 50%, I'd say. 260, okay, 270, we're live in the market times 1.5. Okay, so that's 405. Well, if we do two of these, we're risking 540. So if we do two, single order, first trigger sequence, right click, opposite order, our target is going to be 405. Good till canceled. So why do we want to be out before earnings? Because stocks can gap up or down. You know, and we've seen a lot of both. And if it gaps in our direction, well, we could throw our shoulder out for patting ourselves on the back and we're feeling kind of brilliant. But if it goes the other way, like all of a sudden we've gone from maybe a profitable trade to a max loss like that, and then there's very little time to recover. Okay. So fire in the hole on that one. And so, you know, part of our example trading plan might be that we don't want to be in these short-term trades over earnings. Now, you know, others might say like, hey, I want to do this as an earnings trade, especially if you're selling something and doing, say, a short put vertical where the premium's going to be higher. Now, I want to bring this up because if you're saying like, you know, our trading plan, what's, you know, what kind of trading plan are you talking about? We've created some example trading plans. And again, these are just examples. And if you were trading a short put vertical over earnings as an earnings trade, then your short put vertical trading plan might look different, right? So if you come to these trade management mini sessions, there's a bunch of example trading plans in here. And one is for a long call with a 1 ATR target. This is foreshadowing, my friend. Okay. Are we okay now? Okay, so sorry, we just had a teensy little commercial break there. But I don't know quite where I left you, but these are some example trading plans, and I'll be adding to those. I'm going to do an example stock trading plan, a trend trading growth stock trading plan, and you'll see that in the next week or so. There's also a part 2 to this mini session on the power of compounding and the, you know, what $5 a day can do over time. So I encourage you, if you haven't looked at that one, I encourage you to check that out. Okay, and then the last section here is some, you know, quick and easy things on Thinkorswim. Okay. Yeah, no, I wasn't going to look at TTD today. I don't know. I haven't, that one wasn't on my radar. Yeah, and we probably won't have time to look at that one today. So we looked at Netflix. I wanted to do a quick review on AVGO. We did CrowdStrike. Okay, because on Friday we decided to exit AVGO. And, you know, we had a conversation in Friday's class. So we had sold a short put vertical on this day. You know, we had a pennant with a breakout. And, you know, it was 3 days into the breakout, looked good. Then it pulled back. Still, we were looking fine. Then we had, you know, the Chinese, you know, thing and announcement. And this stock was one of the ones that got hit really hard. And so that happened on the Wednesday. The stock tanked, and now it's below both strikes. So in paper money, it won't get assigned, but in a live account, there is a risk of assignment. And then we had what looked like might be a Harami pattern, which is a bullish sign. And then we had a bearish engulfing. So we decided to lock in the loss. And the conversation around it was that in a paper, in a live account, if you were in this situation, being so deeply in the money, your risk of assignment might be higher. And so we chose to exit that position. Of course, then what did it do? It started to move to the upside. And had we stayed in that position, it would now have been, at a we would now be, in the green on it. Yeah. So we'd now be in the green. But we made the best decision that we could with the information we had at the time. Now, some people will say, well, I position size so that I could afford to take max loss. And if it's assigned, it's kind of assigned. The assignment is, I don't know if you'd call it by lottery or it's a random process. So you don't know if you're going to be assigned, and you could have 3 contracts and one could be assigned and not the other 2. Like, it doesn't mean that all of them would be assigned. But in this case, if you were assigned and had to buy the shares at 235, then what you would have done is turned around and because you bought at 235, you could have turned around and then sold at 230 and exercised your right to sell by having bought the put. Okay. So, and you know what? Sometimes these things happen and then you feel brilliant. We didn't take a max loss on this. I think we bought it back for $4.15. So we could have lost another $85 on it. And then sometimes it continues falling and you feel kind of brilliant. And then sometimes it rallies and you're going like, for crying out loud. It's some days in the markets can be frustrating. Like, what can I tell you? But I just wanted to review that, to go back and look at that again. But I think that I would consider that a successful trade, even though it lost money, in that we watched it and we managed it and we made the best decision we could with the information that we had at the time. Now, somebody asked how long it takes to manage these trades. So if you come and look at these short verticals, TTD got clobbered. So that's, why we're being asked about that. We'll look at that one again, maybe on Friday. But, when we look at these, we've got 3 that are in the green, and, we have 2 that are down today, TTD being one of them. But, when you're down 45%, and C is another one, that I was going to talk about, where we did 3 trades. And so rather than cover it in this class, I'm going to do a mini session on the 3 trades once we're out of the short put vertical. But this is one that got hit on Monday. It pulled back. Our strikes are at 79 and 78, and it's sitting right in between them right now. But the expiration date isn't until the 21st. And so we have some time to kind of let it do its thing. So we're going to let it percolate. On the long verticals, so let's come in, and here's Dollar Tree. We did an iron condor on that. And this is what I call a credit spread sandwich. So we want it to stay below 77 and above 65. And so far it's playing along nicely. So we're just going to continue to let that one percolate. Okay. Okay. And then if we come to the monitor tab, and let me just close these so it's less distracting. So with our long verticals, we just want to look, and if something is more than 50% down, our rule is to exit. But Marvel is one of those that got hit with the announcement from China. And today it's up $105. And so if we come and we look at the charts, we position size so that if we take a max loss, It's not going to blow up the account. But this one got hit kind of one of those whipsaw things, and it's been moving up since. So we have till February 20th or 21st on this. So we're going to let it continue to, to do its thing. So that's Marvell. Okay, so where are we time-wise? Okay, we've got some time. So now I want to stay kind of in that communication sector. Our first trade was on Netflix. So let's come back and look at T-Mobile. So T-Mobile, and we talked about this a bit on Monday, it gapped up on earnings. And then if you want to look at the news, and I'm going to post something on X this afternoon, but they've got a $2.9 billion fund for stock buybacks and dividends and debt reduction. So they're looking at doing some stock buybacks. Those tend to have a positive impact on the price of the stock. And then if we're just glancing to say, obviously the stock went up prior, post the earnings announcements, but how are the analysts looking at it? Well, Oppenheimer raised their price target to, 275. Sorry, I'm just trying to get this going here. From 250. Benchmark, they raised their price target to 275. Barclays raised their price target to 250. Oh, sorry, guys. And where are we sitting now? We're at 240. JP Morgan, they raised their price target to 265. Scotiabank to 247. It's interesting, there's kind of a range between 247 and kind of 275-ish. But, might we want to place a bullish trade? And, what might that trade look like? Well, could we do, a long call vertical? And I know we've done a couple of those today. And could we do, a long call? And we could do a long call on this if we wanted. And if we did a long call, and we went out to March, have we got enough contracts? Well, there's a $10 bid-ask spread. We've got lots of volume, actually lots of volume traded even today on this one. Stocks traded over 1 million shares. And, what might we put as a target? Well, what if we put the previous high around this 248? And that would be called a swing target. So what if we came up here to 248 and we made this our swing target? So we'd buy the call now and then say, if and when this goes up to 248, we'd like to get out. So we're going to come to the trade tab. We're going to come out to March 21st. We're going to buy a call. How many are we buying? Well, we're only buying one. Why is that? Well, because if we bought two, it would be over $600 in risk, and that's just too much above our target. And we're going to buy custom with an OCO bracket. So our target, we don't know exactly what the price of the option will be, but we're going to say, hey, if and when this goes up to 248, the price of the stock, whatever the option's worth, we'll take it. And with a swing target, so some might have a plan that says, hey, and if this loses half its value, then it's probably not going in the right direction. I'd rather take half my money and then live to place another trade another day. So how much could we lose? 320. But we're putting in a stop at a 50% loss. If it goes down by 50%, we're going to exit. And some might say, well, then why aren't you doing two contracts? Because then you're not really risking $320. But if you want to err on the side of being conservative, if the stock gap down, you're not guaranteed to get out with your $1.60. And so it's just a more conservative position sizing approach. And, the last 5 years we've done, all right, being conservative. And so sometimes you may make a little more, but then there are days, and you're kind of going, snap, I wish I'd position size differently. And then sometimes you're going to look at it and say, dang, I'm grateful I did position size the way I did, because that trade turned out, as it turned out, it went against me. Okay, so we're going to send that one in. That's our swing target. Now, the question you may say is, how long do we expect to be in this trade? Well, that's a good question. And you might say, well, how much does this stock move in an average day? Well, from top to bottom, $5.29. We're only looking for an $8 move. We might be in this trade for a week. We could be in it for 2 weeks. It could start going sideways and we might decide to exit. But let's say our expectation is that we'd be in this trade for a week. And so if we look at this and say, hey, if we come to the trade tab, and if we were in this for a week, what might this option be worth if it went up and hit our target? So I'm going to come to Theo price. We're going to go up by $7.50. That would put us at our target of 248. We're going to come out to February 12th. And I'm not going to, so this kind of gives us a guesstimate. It's not a guarantee, because what if it hits our target on Monday? What if it doesn't hit our target for another week? Then there's another week of time decay. But if we're looking at this, what it's saying is this option that we paid probably $3.15 for might be worth about $5.40 or 47 cents, close to $5.50. And so if we made let's say $2.20 on a $3.15 option, that'd be a pretty nice return. And, we've said, hey, if we're down 50%, we want to exit. So that could be a return in the neighborhood of 70%. But again, I've not taken volatility into account. This is a guesstimate, but it's kind of an interesting tool to be able to look at. And again, I'm on the trade tab, and I came to our option chain, and I chose Theo price. Okay, that's how I did that estimate. So if we wanted to look at another example, we could look at T-Mobile's competitor, AT&T. And here's another stock. It's certainly been uptrending. And I think in our trading after hours, we had added this. This was something we had in our portfolio last year, and then we, cleared it out. So let's kind of clear our drawing set here. And so, some might look at this, and, if we look at this on a longer time frame, well, that's a really long time frame, but, we've come up here. It's been, uptrending for a while. And some might look at this and say, well, we had this pattern here, where it kind of created this bowl and then it broke out. Others might look at this and say, well, what I'm seeing, I'm not looking at that so much as, the flag pattern. And in getting started with technical analysis, we, dedicated, I think it was last week's class, to flag patterns, where it's come up, pulled back for 3 days. And then, on Monday, we had this bullish engulfing pattern, which is considered to be pretty bullish. So if we wanted to put a target on this and do a flag target, how might we do that? Well, we come out here and measure from here. Some might go to here, some might come to here, and then replicate that. So I'm going to duplicate that drawing and then bring it up here. So we'd have to add some at the top, or we could just say, when I draw this line, how far is it? It's about a $3 move. So we could just, to make the, because we're running out of time here, if we look at the low on that day, it was 23.67. We could say, okay, well, our target then is going to be 26.67. And maybe we knock it down to 26, because often, these things can be arranged. So let's put a target here of 26. And where is it sitting now? 24.37. And so could we do this with the stock? We could, so we could buy 100 shares or, and put a target in here. And then put a stop. Where might we put our stop? Well, we might say 3% below that 23.66 level. So 23.66 times 0.97. So that's 22.95 is going to be our stop. So we're going to right click, buy custom with an OCO bracket. And we're going to put our stop at 22.95. And we're going to put our target, was it 28? 26. And we're going to make these both good till canceled. Now, what's the advantage of buying a stock as opposed to using an option? Well, the advantage is that you don't have time decay, but the disadvantage is that you're tying up more cash. But, you can afford to be a little more patient. Now, what might we, layer into this down the road? This is a stop with a target. And this is based on a flag pattern. What might we do down the road? Well, yeah, Randy, you've got it. Yeah, we can add a covered call. And if we add a covered call when it's trading already close to the $36 mark, if we come out here, that could add another 36 cents. Or if it went above that, and was at 26 and it was in the money by a little bit, like this is in the money by 37 cents, we could maybe make, 50 cents but you're going to make more if you sell your covered call when it's trading closer to the strike you're interested in selling. Yeah, Gina and Gary, you guys, you don't need me. You guys have got this stuff figured out. Yeah. So guys, that's a wrap for today. So what did we look at? Well, we looked at AT&T and we bought some shares and we put in a target and an exit. We did a long call vertical on the mobile of T on T-Mobile. Oh no, that we did a swing target, didn't we? I was going to do a long call vertical. And then we did a trade on CrowdStrike. And, on this one, we did the, is it showing? We've got 4 filled orders, but we did a long call vertical on T-Mobile and we did 2 contracts. We got filled, 5 cents difference in price, but, we're cool with that. And then on Netflix, we did a long call vertical as well. So, we did 4 different example trades and we did, 3 different types of trades. So, and then we did a quick review on Netflix, on AVGO, and on Citibank. So we crammed a lot into our time. So here's my ask of you. If you haven't subscribed to the channel, hit the button in the bottom right corner. It's free to subscribe. 2, hit the like button. It helps move things up in the algorithm so that more people can find this content on YouTube. And it also lets James and I know that you liked what we did today. Thanks to James for all his work in the chat. And then, follow James and I, James Boyd CS, Barb Armstrong CS, in the land of X. So with that, thanks to the guys behind the scenes for bringing this to life, and to each and every one of you for investing in your financial future by showing up for a webcast like this. Have an awesome day. We'll see you soon.